everyone, my name's Darryl Panes, CEO at As Good as Gold Australia, and this evening once again I'm joined by my brother Brian, partner
Thank you, Darryl.
at As Good as Gold, and this evening we interview Alasdair Macleod, advisor to As Good as Gold Australia. Good evening, Alasdair.
Good morning to you. Oh no, good morning here. It's good evening there.
Yes. And it's good evening over here.
I know, always a little confusing.
Yeah.
Alasdair, things in Australia are just going from bad to worse, aren't they?
Right. There aren't too many good stories out there.
No, they're not. In particular, I guess, for those living in Melbourne. I've got to share this with our viewing audience. Just imagine, I mean, these guys are really going through it pretty tough. They've had the longest lockdown of any city in any country in the world, historically. All right. Point two, they had the biggest earthquake that they'd ever experienced in Melbourne, biggest earthquake ever recorded in history, right, in Australia. And point three, which is the most important of all, they've lost the AFL Grand Final to Western Australia. Now, Alasdair, they may not mean a lot to you, but it means an awful lot to a Victorian. Just appreciate, for as long as football has been played, AFL football, they have played the grand final in Melbourne at the MCG. And this time it'll be played in Western Australia in Perth. I was watching a reporter the other day talk about this, and they said, TJ, this particular gentleman, he's in charge of the footy show basically on a Sunday. Really nice guy. And TJ, how do you feel about this? And you could just see the tears swelling up in his eyes as he looked around and he said, well, there's Melbourne behind me. He said, this isn't Melbourne anymore. This is not the city that I knew. Nothing's the same anymore. And you could see they had to take the cameras off him because he was obviously emotionally caught up in that presentation. But no, Melbourne's had it hard, they really have, and I really feel for them at the moment. So one just wonders how much more they can take.
Not much.
No. Look, Alasdair, many people are asking me a question at the moment that I want to convey to you. They're asking me why gold is not going up. And Brian and myself I believe, have answered that fairly well. But gold's a hedge against inflation. As I read it, we're experiencing inflation at the moment. And yet gold is stable at best. But inflation is there, and we can see it in property prices that are just continuing to break all-time records. Used cars are just breaking all sorts of records. People are paying almost as much for a used car as they are a brand new car. And food items all going through the roof. Yeah. So inflation is running rife. But I think the markets actually believe the Fed, who says it's transitory. This is the only answer I can come up with, that they've accepted this, that inflation is transitory. The problem I have with the Fed and the government in your country is that they've got a very bad record when it comes to making reference to transitory. Example, Nixon 1971 closed the gold window, said it was transitory. It remains closed today. Bernanke promised QE would be transitory in 2009. We're still experiencing QE. So right now, when they say inflation is transitory, why would we believe anything they have to say? A friend of mine, and I keep repeating this, said a number of years ago, Alasdair, if somebody tells me a lie once, I've got to ask myself the question, how many times have they lied? So why would you believe them now? I mean, here's the position at the moment. The US is sitting on 28.5 trillion public debt. Realistically, they have 4 tools to address this debt. 1, raise taxes. 2, cut spending. Neither of those would have any appeal to a government that wants to win the next election. So I would suggest that those 2 policies would be doubtful. 3, they could declare themselves bankrupt. And I'd say that there's a high probability that will not occur. 4, they can devalue their currency through inflation. If they do that, my opinion is that's exactly what they'll do. But if they do that, then it's not transitory under any circumstances, because this is going to they're just going to continue to do this. This is long term, and I just can't understand how anyone could believe anything else. I'd like your point of view on this.
You're right. The inflation is not transitory. And I guess that the establishment in the form of central bankers, US Treasury ministers, and all the rest of it, actually are getting the point that this is not transitory. The problem is that they feel that if they admit that inflation is a problem, then it will make the problem worse, because while they have really divorced completely the idea of inflation being at its root a monetary problem rather than a price problem, it's the devaluation, it's the loss of purchasing power of the currency that you witness when what we call price inflation is evident. They think that if they let people understand that this is a problem and that prices are going to continue to rise at a faster rate, that will encourage people to spend their liquidity on things they don't need today, but they might need tomorrow. In other words, it would, if you like, release a further wave of consumer spending, without the production being there to meet it. And so, the moment the authorities admit that this isn't a transitory problem, then they risk driving, the purchasing power of the currency down even more. So I think they've got sort of stuck in a bit of a bind on this one. In terms of, I agree with you about the means of dealing with it, and that is that they can either cut spending or raise taxes, and that's about it. No government is going to admit bankruptcy. That is something that the markets may or may not force upon a government. And as to trying to manage a lower exchange rate, you've got to bear in mind that in the US dollar, which everybody's tied to one way or the other, there's roughly 32 trillion of foreign ownership of financial assets and cash dollars. 32 trillion, that's 1.5 times US GDP. If you sort of start sending out signals that you're going to try and see the dollar go down, then all that's going to happen is you're going to trigger an avalanche of selling of the dollar, which will drive commodity prices up considerably greater. The effect on individual currencies will depend on the response, if you like, of the central banks involved. So, that's always a sort of slightly complex thing. But really, what you're looking at under those circumstances is the foreigners basically sell their dollars. They sell their dollar assets. They crash the market, incidentally, because they've got roughly 12 trillion of that in equities. So they come out of that and the equity market collapses. What the central bank would probably end up doing, or more accurately, the Treasury and various departments, is intervene in the currency market to try and support the currency. Now, what happens then is they start contracting the amount of currency in general circulation, because the moment the central bank steps into currency markets and starts buying dollars, it's reducing the amount of dollars in circulation. It's as simple as that. So, when they do that, then they drive up interest rates. So, and if they don't do it, the foreigners won't stop selling until, in theory anyway, they see interest rate compensation sufficient to persuade them to hold on to their dollars. But then you have to ask yourself, what level is the equity market? What is the yield on US treasuries? I mean, it's going to be enormous. And that's going to, again, going back to the point about bankruptcy, the markets in effect will judge the US government effectively bankrupt. So because, I mean, it's one thing financing, huge quantities, so 28 trillion, whatever the figure is, of US debt and US currency, which is also debt, incidentally. It's all debt. The whole thing is debt, or credit, the other side of debt. There's sort of trying to hang on to this tiger is just getting more and more difficult. And they're also getting conflicted, and they're very confusing messages coming out of all this, because here we are with the inflation not transient, but we can't admit that. Yet the Fed yesterday made a statement to the effect that, we look forward to tapering, probably tapering starting at the end of this year, whatever. But hold on a minute. What's the point of QE? The point of QE is to ramp markets. So what they're saying is they're going to be taking money out of the, money which the markets expect and upon which markets are priced, future money, they're going to reduce that flow, which basically means that markets will fall. Hold on a minute, what are they trying to achieve here? The problem is everybody sort of thinks in terms of, we have got an inflation problem. What we have to do is we have to stop printing money. But the problem is they can't stop printing money because markets will start collapsing. So, I mean, really, the Fed, I think, has got itself into a blind alley. But it's not just the Fed. Go and look and see what's happening in the European Union. The ECB is basically funding all Euro member states' government funding. I mean, basically the price at which they're buying this stuff in the market is self-evidently a price that the private sector is not prepared to pay. So in other words, the ECB is monetizing all the debt in the Eurozone. And look at Japan, same thing. I mean, the difference with Japan is that through an accident of history, perhaps, they have got savers. And so what happens is that you can run a huge, great deficit, but as long as people don't actually spend the money that they end up with as a result of monetizing that deficit, and they save it, then this is not reflected in a surge, if you like, in consumer prices. And there's another aspect of this too. They have been pursuing this policy for so long that what they've had to do is to corrupt the numbers to make it continue to look as if everything is all right. We have, you look at CPI. I mean, the CPI is now in America running at 5.3%. I think that was the last figure. The CPI, I mean, we can talk about the general level of prices in terms of economic theory. But the one thing we cannot do is we cannot measure it, because what I buy is not the same as what someone else buys and someone else over there buys. What we buy and what we experience in terms of change in the cost of living is an intensely personal thing. And in America, this is a personal thing to 360 odd million individuals.
Sure.
You can't, we can theorize about a general level of prices, but you cannot measure it. What this allows is for the authorities, in this case, the Bureau of Labor Statistics, to basically make up the numbers. And isn't it amazing how over the years they've been targeting 2% inflation? And guess what? It works out somewhere between 1.75 and 2% almost all the time. It's almost as if it's a gold salt total. Meanwhile, you have got John Williams at Shadow Stats, who calculates exactly the same numbers, but on the unadjusted basis, taking out all the changes that the Bureau of Labor Statistics have introduced since 1980 to keep the numbers down. And what is he saying? His indication is that the rate of price inflation is running at well over 13%.
Right.
So,
Wow.
do you trust the numbers? No. But the amazing thing is that the markets hang on every 0.1 of a decimal point in terms of where this is going. I mean, if the CPI is going to be announced and it's 0.1% or above or below, everybody gets terribly excited. What? This is complete nonsense. I mean, it really is. And there is a fundamental problem in this, and that is that the whole of the Keynesian paradigm is mathematical economics. It removes completely humanity out of the statistics. But economics is about human behavior. And the thing that matters to us more than anything else is time, because if we're going to do anything, time comes into it. How long is it going to take for me to acquire what I want to buy or what I want to achieve in terms of making money or whatever the ambition might be? Time is vital. It is central to everything we do. Yet when you look at GDP or any of these statistics which are meant to represent economic activity, time is taken out of it completely. There's no time in it. They are completely meaningless. So, we're living in a world which is completely different from what the economic establishment seem to think, or are trying to represent, if you like, in terms of mathematical statistics. It is completely wrong. Now, sooner or later, reality comes up against all these big, big errors. And that, I think, principally is what we're seeing at the moment. If I can go back to, the point you made about, people say to you, Darryl, but, gold is going nowhere and all the rest of it. I think another way to look at this is in terms of bubbles and anti-bubbles, if you like. There is a financial bubble in financial assets. I mean, of that, there is absolutely no doubt at all. The bit that is a bit more questionable, takes a lot more understanding, is that this bubble also exists in currencies themselves. They're wildly overvalued, if you like, really through central bank action, trying to persuade us all that they have a purchasing power which is only going down at 2% per annum, which is mild encouragement for those of us who might otherwise sit on cash, sort of thing. So we are in a fiat money bubble. It is actually as simple as that. Gold is the anti-bubble.
Yes.
And the reason that gold is going nowhere in this, if you like, conceptually, is because if you accept that gold should go considerably higher, and I'm talking about people as a whole, rather than, those of us who sort of are either dedicated gold bugs or, are making an economic argument or whatever. But if you really do think, as an ordinary member of the public, let's say financially literate or relatively financially literate, and you think that gold is going up, then by definition, what you're saying is that everything else is in a bubble. So I think the way to look at it is that, there's bubble and anti-bubble. Gold is the anti-bubble. When the bubble goes pop, at that moment, if you haven't got gold, then I feel very sorry for you, because you're not going to get it. And this is the reality of the situation. The relationship between fiat money assets and gold is so heavily in favor of fiat money assets. Very few people actually have gold. I mean, go and talk to portfolio managers. Do they have gold? No. A few of them might have something like, say, futures, a futures position, or they might even, if they're allowed to do it by their compliance officer, they might even have an unallocated account, gold account at a bullion bank. They might own some gold mines and think that's exposure to gold. They might even have some ETFs and think that's exposure to gold. Well, it's not. It's exposure to a vehicle which whose principal asset is gold. I mean, fine, but you don't have title to gold. And if we are right and the bubble really does collapse and it takes fiat currencies with it, then owning ETFs is not going to be owning gold. It really is not. There are big risks in there between your supposed ownership of gold and gold itself. So possession of gold, I think, is terribly important, but it does take this understanding that gold is the anti-bubble, not the bubble.
Yes.
Also, I'd look at this from the point of view of the market as well. I mean, the market is divided into, obviously, bulls and bears. Now, the bears in the market are basically the establishment. And the establishment of bears, conceptually, because they don't want to see a rival to fiat currencies. And we've seen this demonstrably with the US monetary policy. But the other thing is that if you look at who's actually short in the market so that we are long, let's say, and I'm talking about the forwards market, and I'm also talking about futures, then they are the bullion banks, the bullion bank establishment. And they are short of huge quantities. I mean, we're talking about figures in the trillions. So when the bubble pops and the anti-bubble then begins to emerge, you can see that there is a huge problem with the establishment. Basically, at the heart of the complete monetary system is gold, not the dollar. Gold is the only form of money for which there is no counterparty risk. No physical gold I'm talking about. Now, so when the bubble pops and the anti-bubble begins to emerge, it's just not going to be available. It's not going to be available for the bullion banks. It's not going to be available for the governments who have leased it out. So what chance have we got as individuals to get hold of gold in those circumstances? So what I am saying is that this is very much more a black and white situation than what the critics who have approached you, Darryl, and said, why isn't gold moving? You've got to look at this in terms of gold actually is that anti-bubble. It is money in the absence of fiat. Every time government currencies have collapsed through, so far as we know, the last 5 millennia, it has been replaced by, guess what? Gold or metallic money, gold, silver, and going way back, copper. So, gold and silver are really the two things. Now, silver, I think, has an added advantage, and that is that it's not beyond the bounds of possibility. In fact, I would say it is quite likely that in a fiat currency collapse, governments might turn round and try and restrict gold ownership, if only to try and save the fiat currency system. Now, under those circumstances, you might find that you can't, you're prohibited from buying gold. You might find, as the Americans found in 1933, that a law is passed, an executive order, which forces you to submit any gold in your possession to the authorities. But they can't do that with silver. So silver has, I think, that additional advantage. Plus, if in the run-up to the bubble popping, we see that the price of gold in fiat dollars starts rising through the $2,000 level and so on and so forth, then because silver is roughly twice as volatile, the rise in the price of silver will be about twice as much. So there are interesting dynamics here, but I think to get to the basic point that your critics have made about, why isn't gold going anywhere? Or indeed, take it a bit further and say, why is it Bitcoin is taking over this role? Your explanation, I think, is in terms of bubble and anti-bubble. And I think if, understanding that, you can see that actually what we're doing by buying gold is we're not looking to see the price go through $2,000 or, whatever the bullish projection you might, personally make. What we're looking at is the acquisition of real money without counterparty risk, which we will spend. That is the key point. And we will spend it because fiat currency will be valueless. Now, you can put on top of that an element of expectation. I mean, is this likely? Is it very likely? Is it going to happen at all? Now, each individual will, based on their own analysis, come up, if you like, with a view as to how likely this is to happen and perhaps how far away the event is. And that should determine the relationship between that individual's fiat currency and fiat assets. And I would also include physical property in this, residential property, property out for let, commercial property, whatever. What's the relationship between that and gold? In other words, if you've got, let's say, measured in fiat assets of $1 million, how much gold should how much of that should you move into gold? And that, I think, then becomes a matter of personal judgment. But the key to it is not to think in terms of gold is an investment. It is part of my balanced portfolio. Actually, it's more like an insurance policy against governments screwing it up. And my goodness, we've seen so much more evidence of governments screwing it up and promoting a bubble to try and cover their tracks, that from my point of view, it is absolutely certain that it is only a matter of time, and probably not very much time, before the whole of this fiat currency paradigm begins to implode upon itself.
Well, you can absolutely guarantee the governments will screw it up. Of that there is absolutely no doubt. And the Fed, and they have never in the past been recognised for warning us in advance that we have a real economic or a depression or a recession
challenge on our hands.
Yeah. You never get any prior warning. And so Alasdair is correct. I mean, when everybody works this out, when the markets work it out, it's too late. You can't get hold of it.
Can't get it.
I agree 100%.
Yeah.
Thanks, Alasdair.
We're going to, I will be continuing on on the same subject, but like I always do, I usually give out facts and figures before I question Alasdair, so bear with me. Before I even do that, there's one little comment, and you nearly stole my thunder here, Alasdair. I read a quote, and you may recognise it. If you have gold, you have money. If you don't have gold, you have a problem. Now, that's one of the quotes from Alasdair Macleod that I read about 3 or 4 years ago, and I wrote it down so I could always remember it. I'm going to take our clients back for the last 100 years, but in 2 areas, all right? The first 50 years and the second 50 years, and I'm going to start in the year 1920, just a few years after the Federal Reserve came into being. But between 1920 and 1970, we had some inflation. We had a lot of debt. But I want to get around this debt situation. I want at the end of the night, or end of this question, Alasdair to answer my question. But between 1920 and 1970, 50-year period, it started off with $24 billion in debt. I think the President of the United States, that's what he started with, 24 billion US debt. I'm talking US debt here. It went from 24 billion to 353 billion over the first 50-year period. Now, in that time, we've got to remember, a lot of those years, we had 40% backing of gold. The US dollar was backed by gold, 40%. Obviously, we had the Second World War in that period, and they went off the gold standard to fight World War II. So this period of 50 years, 24 billion to 353 billion, was a 15 times increase in debt. Or another ways of saying it, 1,500% increase. Now let's look at the next 50 years, 1970 to 2020. The US debt started at that point where it finished off at 353 billion. And today, or 220, and we just about talked about in Darryl's last question, but 353 billion to today, 28,000 billion. And we like to say, or our governments like to say 28 trillion, just sounds a little bit more plausible, not as big, but 28 trillion, fellas, is 28,000 billion debt. Now, that is not 15 times in the 50-year period. That is 80 times greater in that 50-year period, or 8,000% increase. Alasdair, looking at these debt figures and that fiat currencies have an average life of 40 years, it's presently 50 for this fiat currency now, what do you see happening in the next 5 years?
You are right about the acceleration of the rate of monetary inflation, which is basically debt. I mean, when you see monetary inflation, then the counterpart of the money, which is sort of meant to be either central bank money or deposit money, is always the other side of a banking balance sheet, and that is debt. I mean, it's debt which is owed to the banks, if you like. On top of that, there is extra debt, and that is debt which isn't on the bank balance sheets but has been subscribed for out of the broad money supply, if you like, which is reflected on the bank's balance sheets. I did a calculation of where the US situation is. And if you take into account all the private sector debt, government debt, broad money supply, which incidentally is debt as well, because it is, it is the counterpart of debt of assets, financial assets, which are owed to banks on the other side of their balance sheet, then we're looking at a figure which is close to 100 trillion, or in your terminology, 100,000 billion US dollars. Now, that is even before we take account of shadow banking. Now, shadow banking famously emerged at the time of the Lehman crisis, because what banks were doing was they were financing, they were getting around the restrictions, the balance sheet restrictions, by financing mortgage debt in special purpose vehicles. I mean, you may remember these. Now, there was a one-off adjustment that occurred when it suddenly, the Fed realized that there was an awful lot of debt which had been created but wasn't actually on the bank's balance sheets. They were off balance sheet. And so they moved this into the statistics. And this is why at the time of the Lehman crisis, you see there's a sudden jump in the quantity of broad money. So, but today, the Financial Stability Board, which is a subset of the Bank of International Settlements, I think they did this calculation in 2018, something like that. So it's not current, but as current as we can get. They reckon that the amount of shadow banking in the US was a further 52 trillion. Now, that is on top of a money supply of around about, which is M3. So this is, that's the sum of money issued into the public hands by the central bank plus the banking system. That totals around about 23 trillion, something like that, off the top of my head. So that is M3 at the moment. So on top of that, you have got shadow banking of a further 50 odd trillion. Now, not all of that is credit creation. That's the first thing to say. We don't know how much of that is credit creation. So there's probably, I think it's reasonable to assume there's a further 20 trillion there. So we're talking about 120 trillion of debt, if you like, in total, including money, or currency in the US economy. So, this is a bit worse than what you were saying. I mean, you were looking just at the government debt, which is growing apace, let's face it. The problem with all this debt is that most of it, or a large portion of it, is lent either for speculation or it's lent to companies which are not actually getting an adequate return on their borrowings. Now, if you get a rise in interest rates, as we were discussing earlier, inevitable when you, if you like, issue huge amounts of currency and debase the currency so the purchasing power goes down, interest rates are going to go up. I mean, it's as simple as that. Then this is going to drive an awful lot of indebted companies who don't get an adequate return on their invested debt into bankruptcy. So you can see that it's not going to take an awfully big rise in terms of interest rates on that 100 trillion, even putting the shadow banking to one side. This is a really difficult situation, and it's virtually impossible. The other aspect, I think, of this is looking at prices, and your mention of 1970, I think, or 1971 is apposite, because up until then, the official rate of exchange between the dollar and gold was 1 ounce was $35. They subsequently put it up after the Nixon shock, but to 42.22. But the $35 to an ounce against the current price of $17.80, something like that. This means that the purchasing power of the dollar measured in gold, and this is a far more reliable measure than the CPI for reasons that we were discussing earlier. The dollar has lost roughly 98% of its purchasing power, and this is this is not a trivial amount. What we're now looking at is an acceleration of debt in recent years, particularly since the Lehman crisis, but more particularly since COVID came along. The acceleration of the production of debt is going to accelerate the rate, if you like, of loss of purchasing power of the dollar even further. It's not just the dollar, it's everyone else, as you may imagine. But the interesting thing is that going back to the end of that period that you were looking at, sort of 20 to 70, in the late 60s, the strains were already beginning to show, and we had a failure of the London gold pool in the late 1960s. Now, this was an arrangement whereby it was quite obvious that the amount of gold that the US Treasury held was gradually sort of running out of the door. And this was something that they wanted to deal with, because if gold continued to run out of the door, there would be a crisis. Now, the person who described the conditions whereby this happened was an economist, a Belgian-American economist called Triffin. And it became named the Triffin dilemma. And basically the dilemma is this: if you are going to produce a reserve currency, then you have to run your own affairs irresponsibly to ensure that the currency is available for everybody to use it as a reserve currency. Let me explain a bit further. What it meant is that the Americans had to run budget deficits. They had to inflate their currency in order to make it available for the foreigners, because only if it was available in quantity for the foreigners could it actually act as a reserve currency. So, coming back to Triffin's point, you have to run irresponsible economic and monetary policies in order to provide this reserve currency for the rest of the world. But Triffin didn't stop there. He said, inevitably, this ends up in a crisis. Now, the crisis, the Triffin dilemma crisis that we saw in the 60s was the failure of the London gold pool. And they basically patched it up by getting another agreement together with particularly the European central banks and the Bank of England to try and sort of hold the position. And that finally failed in 1971. So that was the Triffin dilemma, if you like. Now, if we think in terms of the Triffin dilemma, we then got onto a new Triffin cycle, because replacing gold as the reserve currency, reserve money, as it were, with the dollar as a reserve currency, basically meant that the Americans had to produce lots and lots of dollars in order to satisfy global demand for it. Now, the first element of this really was the advent of the petrodollar. And that was an interesting one, because Nixon and Kissinger back in 1973 agreed with the Arab oil producing nations that they should take dollars in payment for oil. Now, what this meant was that under the correspondent banking system, they were taking dollars out, being paid from US banks and redepositing them in US banks. Not necessarily directly, but, if they, let's say, used, a local Islamic bank, then, through the correspondent banking network, those dollars actually went back to New York. Those dollars were then loaned out to Latin America. Because they wanted Latin America to remain, if you like, within the American sphere of influence. Because you will recall that in those days, and we're talking early 70s, the Soviet Union was pushing very, very hard, to persuade the regimes out there to be communist. I mean, we're talking about the days of Che Guevara and all the rest of it. So you can see that. There's the political logic in this, but that all went wrong. So what happened? Did the Arabs suffer from this? Well, they didn't really, because it was all guaranteed by the Americans. So that was fine. But you can see how all these dollars were produced for export. And of course, I mean, a lot of the money which went over to, say, Argentina and so on, all ended up in the, military generals' pockets and the politicians' pockets. Nothing changes in this world. I mean, we know that this has always happened. So, the dollars didn't actually disappear. What happened was that, hapless subscribers for loans to Argentina and all the rest of it basically lost it, but the dollars went somewhere else. So, it expanded and expanded and expanded. And we're now in the position where it has expanded roughly in line with the numbers. In fact, more so, the numbers that you suggested. We started with what was 350 odd billion in 71, and now we've got whatever. Now, I would claim we're looking at 100 trillion once you include all the the debt and all the rest of it. So huge quantities. I mean, more specifically, recorded foreign ownership of US financial assets and dollar balances is in the region of, as I said earlier, $32 trillion. So that gives you a rough idea of the force behind the consequences of the Triffin dilemma. So I would take your 50 years slots and say Triffin dilemma. And I think we're coming up towards the second crisis phase of the Triffin dilemma.
To summarise that, thanks very much for the answer, and a beautiful answer too. So I look at that for 50 years. In that 50 years, we've had since 71, we've had no gold backing our currency. The average the average time span is 40. So along with Alasdair, we haven't got long to go before this starts to crash down. Darryl?
Yeah, I'd agree. And I think this could quicken up the whole process. Last week I asked John Adams, our chief economist, Alasdair, of course, this same question, but I would like to get your take on it. So last week we saw China's property developer, Evergrande, of course, with liabilities approximately $305 billion, run into some serious financial trouble as it faces a liquidity crunch. Shares in the company have collapsed by 80%. And investors have stormed the company headquarters demanding the money back. Some have jumped on the news claiming it's China's Lehman moment. Now, a couple of stats here. Evergrande owes money to about 171 domestic banks and 120 other financial firms. So if the company defaults, there will be serious ramifications within the banking system, and not just in China. So UBS estimates that there are 10 developers, this is staggering, 10 developers with potentially risky positions with combined contract sales of 1.86 trillion yuan, or 2.7, this is the important thing, 2.7 times Evergrande size. So really what we're saying here is that Evergrande is only the tip of the iceberg. So Beijing bails them out. Let's say they do. that would send a dangerous message to other heavily indebted developers. If they don't bail them out, the fallout could be absolutely catastrophic, spread to other sectors of the country. Alasdair, I just think this is big. I really do. I'd really like your take on what you think or how you think this is going to play out.
There is no doubt this is a serious problem, but I think we have to put it in some form of context. The first thing I would say is that the Chinese, ever since, certainly since 2015, have been discouraging financial speculation within the domestic monetary system. They've done this for a number of reasons, which I won't go into. But the point is that while Western nations, led by the Fed, have been puffing up a financial bubble, China has been deliberately stopping a financial bubble from arising. She's done no QE whatsoever, which is an important point. If you look at the stock market from 2009, the beginning of 2009, the Shanghai Composite has risen something like 84%. Whereas at the same time, the S&P 500 has risen over 450%.
Right.
The bubble is not in China. So I think that's the first thing we need to understand. Now, okay, I'm talking financial assets. In the case of Evergrande, we're looking actually at property development, so we're looking at physical assets. This is the sort of problem that comes along even when the rate of monetary inflation in a country like China is subdued compared with what's been happening elsewhere. It is true there is a high level of private sector debt in China, and if you get an expansion of private sector debt, then quite obviously, you're exposed to a cycle, if you like, of contracting bank credit or rising interest rates, or however you want to put it. So that, I think, is the background in which you've got to look at this Evergrande situation. I have no doubt that Evergrande is bust. The market isn't usually wrong in these things. And I have no doubt that there are other companies in the same situation. But I think the fundamental difference between the Chinese approach to these private sector difficulties and our approach, if I can say us in the West, is that we will try and bail out something which we assume is a systemic problem. The Chinese won't bail it out. What they will do is they will manage the situation through, but Evergrande will go bust. Of that, I feel absolutely certain. I don't see the Chinese aping what we do. They have deliberately gone against, puffing up markets, encouraging speculation, and all the rest of it. And if you look at everything they have done, they've actually been a lot more responsible than we have in terms of monetary affairs. Now, I'm not saying that I think the Chinese government are wonderful and all the rest of it. I'm just saying they do things in a different way. There are lots of aspects of the Chinese government that I would not tolerate, but we're just talking purely in terms of managing a money situation rather than, let's say, the broader democratic point. This is something that I think will look probably a little worse before it gets better. But if you've got problems in China, I tell you, they're absolutely nothing compared with the problems down the road with all the zombie companies relying on zero or even negative interest rates in the West. The deposit rate in China, I looked this up, is 2.9%. Interestingly, the market rate is 2.2%. Now, what that tells me is that the monetary policy of People's Bank of China is actually restrictive. If it's holding at 2.9% and the market rate is 2.2, then you can see that it is actually putting the brakes on the whole situation. Now, we know this because it is policy to take the speculation out of the economy. And that tells us that this sort of situation is something that is really baked in the cake. I mean, if you're going to run a restrictive monetary policy, and the other thing is that is interesting is that China has deliberately jumped down on shadow banking. Under those circumstances, you're going to have the Evergrandes of this world. So this is no surprise. The other point I would make is that I had a look at the share prices of the GSIBs, the global systemically important banks in China, all of which are state-owned, admittedly. And when you look, I mean, the share prices are way down. I mean, they really are. But if you look at what's happened in the month of September, I would say they do not reflect a developing credit crisis in that broader sense. They're down. They're below the highs that we've seen in September. I mean, they've come off a bit, but this is not crisis stuff yet. I mean, it could be that markets take the view that this is a crisis and it's going to get worse before it gets better. But all I'm saying is that so far, on the ground in China, yes, this is an issue, but it is not the systemic issue that a lot of China's detractors, sort of fear. So I'm not saying that your fears are not well-founded, Darryl, but what I'm saying is I think we need to look at it in the context that there's less bubble, if you like, in the Chinese economy than there is in the sort of economy which we would actually naturally compare it to, which is our own or America's or Europe's.
Yeah, I was just thinking, I was looking at these 10 developers that UBS has referred to and thinking, okay, if Evergrande goes under, and you're suggesting that's a strong possibility, then what's the possibility of these other 10 major developers experiencing the same fate? I think they'll be under a lot more scrutiny now than they may have been in the past.
Oh, undoubtedly, this is right. And I think that, the Chinese monetary authorities will be well aware of the situation. But I think that the key to understanding this sort of problem is in the amount of speculative fuel that will be unwound by this sort of suddenly surprise. This is not like a Lehman moment where everybody was up to their necks in mortgage debt. I mean, they really were. And foreigners were buying into this stuff as well. This is not a similar situation in that sense. I'm not saying it's not serious, but to compare it with Lehman, which is our natural instinct, perhaps, is I think, completely the wrong thing to do.
Okay. Well, we'll watch with interest.
Absolutely.
Very much so.
What sort of came to mind while you guys are talking about that is that the big difference I see between America and the West and the East, especially China and India, they encourage their people to buy gold. And of course, China's government is buying a lot of gold, whereas the Western governments, all they're doing is selling it. So maybe it'll be very interesting to see how this really comes out. My last question, Alasdair, probably it is a simple one, and I do believe I know what you're going to say, but I'd like it to come from you, not from me, certainly for our clients. Alasdair, if you made the decision today to start saving in gold and silver, so you're a new client, you are a new person, you've just been told about gold and silver, and you've made the decision to think about it, read about it, educate a bit more. If you started saving in gold and silver today, would you have a preference with either gold or silver, or does it really matter? And in what sizes, what ounces or kilos of the metal would you buy?
Well, this is a sort of question of how much money I've got to spend, in a sense. So I'm going to duck that bit.
Exactly.
I'm going to duck that bit. But no, I would have some of both. And we've touched on this a little earlier because I have no doubt that Western governments, as they see their own currencies going down the toilet, they're going to, they will certainly be tempted to put restrictions on gold ownership. So I would have some gold ahead of that, and I would make it as difficult as possible for my government to get hold of my gold. Now, I can't obviously recommend to people that they should break the law. But what you can do is you can make it slightly more difficult for governments to obtain your gold. And one way of doing this is to store it in vaults abroad so that it's not in the same jurisdiction. If you're American, also think in terms of the ownership of the vaults, because an American government could turn around to Brinks, for example, which I understand is an American company, and command that company to make a return of all the gold held in their vaults, both in America and abroad, for US citizens, and demand it's returned or whatever. I mean, we just don't know. But the one thing we do know is that the concept of property ownership suddenly gets overridden by governments in a monetary panic. So these are just considerations which I think you bring into if you like your view. The other thing, I mean, we have the advantage here that we have a coin which trades at something like a 5 to 7% premium over the gold price, and that is the sovereign, the gold sovereign. The further advantage of that is that if I'm wrong about timing and things just go on and on and on, but the value of the sovereign goes up measured in pounds, then it's free of capital gains tax because it is a coin of the realm. So that's another way in which you can go. I don't know what the legal situation is in terms of tax in Australia, but you have got similar coins, both gold and silver, which may or may not qualify for tax-free status. As far as silver is concerned, I think silver has the advantage that, one sort of hackneyed phrase going way back is that gold is the money of kings and silver is the money of people. Silver actually lost its purchasing power substantially back in the 1870s. Now, the reason for that is that the continental countries moved off silver standards into a gold standard. They copied the UK in sort of really 1870, 1873. So effectively, the reason that silver is currently trading at something like 78, a ratio of 78 to 1 to gold, is that it is effectively demonetized. Now, in the case of a fiat currency collapse, then obviously this is going to come back as money. And so, we would get back down towards the relationship which traditionally existed between gold and silver when silver was equally regarded as money as gold was. Now, I needn't necessarily say that, we're going to go see it back down to 15.5 to 1, roughly Isaac Newton's fix, if you like, in 1723 or whatever it was. But you can see that just returning towards a monetary role will take the price of silver relative to gold right down. And I would suggest that seeing this down to somewhere between 20 and 30 times, rather than the 75, 70 to 80 times, is quite likely. So you're going to get more bang for your silver buck than you get out of your gold buck on that basis. So I would say that however much money I've got to spend on it, or how much money I want to get out of. I want to get out of fiat into the real stuff, out of the bubble into the anti-bubble, if you like. Then I would certainly have probably half of it in silver and half of it in gold. And on dips in the price, I mean, when you get a dip in the gold price, you see this gold silver ratio. Silver tends to dip even more. So as that ratio increases, then I'd probably add to my silver rather than to gold. So that I think is about the only way I can answer the question. But the important thing is to have either immediate possession of it, in other words, have it to hand, or alternatively, have it in insured vaults in your name, or held through an agent who acts as a custodian for that gold or silver on your behalf. I I don't have a problem with that. What I do have a problem with is anyone who has your gold and silver on their balance sheet. That is a no-no. You must not go there.
Quite true.
Because you don't have possession. You just have, it's rather like a bank deposit account. It's not your money. You are owed it by whoever is looking after it for you, and they have it on their balance sheet. So that is important. In terms of anything else to consider in that one, I think that one thing that is important is that you don't tell people how much gold and silver you've got to hand, because for the very simple reason that you're laying yourself. I mean, just think about the conditions when fiat currency goes. I mean, there's going to be a lot of lawlessness. So you've got to think in terms of personal security. Put that on top of the whole thing. So work out how you're going to deal with this. And you don't want anyone to know what your position is. That has to be kept very, very quiet. So I'm not going to tell you how much money I've got and how much I got nothing. I've got nothing.
Your answer is perfect, and it's certainly exactly the way I consider holding gold and silver. 50-50. Nobody knows how much you have because you don't tell them. Darryl?
Yes, I'd agree with that. And I think most people who invest significantly into precious metals keep it that way, from my experience. Yeah. What I will say at the moment, just in closing, is that what we have noticed is the demand for silver has just accelerated dramatically. I know
last few months has been fantastic.
I've spoken to a few bullion dealerships in the United States. They're the same. They just can't get enough of it, and that's a really important point. When there's this big drive towards purchasing either gold or silver, it becomes far more difficult to get. And what's happening at the moment, we're going to see some increases in premiums. Our refiners, we have 3 refiners supplying as good as Gold Australia at the moment here in Australia, and they're all telling us that they just can't source it from their normally regular suppliers, so they're going to have to pay higher premiums to get it. So we were warned about this, and we advised our viewers going back about a month ago that this was going to happen, and it's on our doorstep right now. So we've had a huge demand for silver this month, haven't we? Absolutely massive. So I think it's about to launch. We said at the start of the evening, why is gold, stationary? Why isn't it doing anything? I don't think we're going to have to wait long.
No,
I really don't.
Launching pad is very close by.
Yeah. Look, Jim Sinclair, I think it's worth mentioning Jim Sinclair's comment. Hey, central banks around the world all own gold, or most of them do. Australian Central Bank doesn't own much, but the vast majority do. And so why? Because it supports and backs their currency. It gives their currency some value in an absolute time of need to do so. It's real money. It's a hedge against inflation. As Alasdair has said tonight, I would hate to be on the other side of the equation and not have any. I really would. Egon von Greyers, and we keep referring to Egon, wonderful friend. And Egon, upon being asked the question about how much gold and silver one should have, and he says, whatever you can't afford to lose. A very powerful comment, and I'm very supportive of Egon. I've been, along with Brian, we've been investing in precious metals or putting aside gold and silver for the last 30 years, haven't we?
Yes, that's right, and we haven't looked back since we started.
Well, here's the thing too, what is really important to remember, it's a bit like being on a plane, and the hostess says, we've got a problem, so the masks drop. The object is to put one over your own face first so that you can protect the person, you can do something to help the person next to you. If you don't have any gold in economic chaos, then you're not going to be able to help your friends, family, and those who may not have protected themselves as well as you.
Yeah, exactly. Another phrase I heard in the mid-70s was poor people cannot help poor people.
Correct.
And it's quite true. So only when you try to succeed and obviously look at that direction that you can help others along the way.
Yeah. Alasdair, thank you so much once again for your support, your ongoing support. You're a wonderfully researched man, and we feel as though it's a privilege to have you on board working with As Good as Gold Australia. Thank you so much. Thank you so much to our audience, our viewing audience, subscribers who continually support this channel. And I guess until next time, I can only say stay well, stay focused, and goodbye for now.
Goodbye for now.